Traditional IRA versus Roth IRA. Which retirement savings vehicle is right for you? Are you ready to take control of your retirement savings? Choosing the right IRA is a critical step. Let's dive into the world of traditional and Roth IRAs to help you make an informed decision. Disclaimer: the information provided is for general educational purposes only and should not be considered financial, legal, or professional advice. Always consult with a qualified professional or trusted advisor to determine the best course of action based on your individual circumstances. Traditional and Roth IRAs are both powerful tools for building your retirement nest egg. They offer distinct advantages and cater to different financial situations. Knowing the key differences is essential for maximizing your retirement benefits. While both are individual retirement accounts, their tax treatment and operational mechanics differ significantly. One offers upfront tax benefits, while the other provides tax-free income in retirement. Let's explore how they work. A traditional IRA allows you to potentially deduct your contributions from your taxable income in the year you make them. This can provide immediate tax relief and free up more cash for other investments. The real impact of a traditional IRA is felt later. In retirement, you'll pay income taxes on all withdrawals, including both your original contributions and any earnings. This is a key consideration when planning your retirement income. With a Roth IRA, you contribute after-tax dollars. This means you don't get an immediate tax deduction in the year you contribute. However, the long-term benefits can be substantial. The biggest advantage of a Roth IRA is that qualified withdrawals in retirement are completely tax-free. This includes both your original contributions and all the earnings your investments have generated over the years. The primary tax advantage of a traditional IRA is the potential for immediate tax savings. By deducting your contributions, you can lower your taxable income and potentially reduce your tax bill for the year. This upfront tax deduction can be particularly beneficial if you're currently in a high tax bracket. It allows you to defer paying taxes until retirement, potentially when you're in a lower tax bracket. The Roth IRA shines when it comes to long-term tax benefits. The tax-free growth and tax-free withdrawals in retirement are a powerful combination. This can significantly boost your retirement income. If you anticipate being in a higher tax bracket in retirement, a Roth IRA can be especially advantageous. You'll pay taxes on your contributions now, but avoid paying taxes on potentially larger withdrawals later. For 2024, both traditional and Roth IRAs share the same contribution limits. This makes it easier to plan your retirement savings strategy, regardless of which type of IRA you choose. The contribution limit for both types of IRAs is $7,000 per year. This is the maximum amount you can contribute if you're under the age of 50. If you're age 50 or older, you can contribute an additional $1,000 per year as a catch-up contribution. This brings your total contribution limit to $8,000 per year. Remember that your total contributions across all your IRAs, traditional and Roth combined, cannot exceed the annual limit. It's important to keep track of your contributions to avoid penalties. Roth IRAs have income limitations that may affect your ability to contribute. These limitations are based on your modified adjusted gross income, MAGI. For single filers, full Roth IRA contributions are not allowed if your MAGI exceeds $161,000 in 2024. If your income is above this threshold, you may be limited in the amount you can contribute. For married couples filing jointly, full Roth IRA contributions are not allowed if your MAGI exceeds $240,000 in 2024. Again, if your income is above this level, your contribution amount may be restricted. Unlike Roth IRAs, traditional IRAs have no income limitations for contributing. Anyone can contribute to a traditional IRA, regardless of their income level. However, the deductibility of your traditional IRA contributions may be limited if you're covered by a retirement plan at work, such as a 401k. This is an important factor to consider when deciding between a traditional and Roth IRA. Withdrawing funds from a traditional IRA before age 59.5 comes with a penalty. Generally, you'll face a 10% penalty on the amount withdrawn, in addition to paying income tax on the distribution. This penalty is designed to discourage early withdrawals and encourage you to keep your money invested for retirement. However, there are some exceptions to the penalty, such as for certain medical expenses or qualified education expenses. Roth IRAs offer more flexibility when it comes to withdrawals. You can withdraw your contributions at any time, tax and penalty-free. This can be a valuable safety net in case of unexpected financial needs. However, withdrawing earnings from a Roth IRA before age 59.5 is generally subject to a 10% penalty and income tax. There are exceptions, such as for qualified first-time homebuyer expenses or certain disability situations. Choosing between a traditional and Roth IRA depends on your individual circumstances, including your current and expected future income, tax bracket, and risk tolerance. Carefully consider your options before making a decision. Ready to take the next step towards a secure retirement? Don't let confusion hold you back. Schedule a free consultation with a qualified financial advisor today to discuss your specific retirement planning needs and determine which IRA strategy is right for you. Disclaimer: this information is for educational purposes only and is not financial, legal, or professional advice. Consult a qualified expert for guidance tailored to your situation. Please like, share, and subscribe. Thank you for watching.